and welcome to another A Life Well Lived, a Physician's Guide to Wealth masterclass. This will actually be dual purpose. We have a physician money podcast as well, so this will be dual purpose. This will be also be released as a podcast episode. It'll be on YouTube in the future as well. So let's jump right in. So you did everything right: med school, residency, the job, the sacrifice, the student loans, the income. But now that you finally started earning real money as a 1099, why does it still feel so unclear? And you're not alone in feeling this way. We've sat down with dozens of physicians who told us the same thing. I feel like I should have figured this out, but I don't. So first and foremost, in just naming the problem, 3 of every 4 American families say money is their number one source of stress. I've been there. I know Jeff and Matt on this Zoom, they've been there, and we all do these things for a living, right? And add to that, 42% of physicians report burnout, emotional exhaustion, and even depression year after year in the Medscape report. And a big part of that stress is money and lifestyle. And nobody taught you what to do with your money, especially when it comes to 1099 income. Heck, I studied finance and accounting in college, not like, I'm not trying to brag about myself. I've definitely learned more in the school of hard knocks since then. And really none of it is applicable to what I'm doing today or like the families that we serve and work for, right? So, and back to you, you paid hundreds of thousands of dollars. You sacrificed your 20s while your friends were living their lives and traveling all over the world and buying houses and all the things. And you poured yourself into training. But on day one of your attending job, no one handed you the financial playbook. And now you're expected to figure out S Corps, solo 401ks, QBI deductions, write-offs, backdoor Roth IRAs, and paying yourself as an employee. We get it. Many of the physicians we work with said they felt overwhelmed too. They felt frustrated that their accountant just files the return without offering strategy. They felt unsure whether they were making the right moves or leaving tens of thousands on the table. And they felt unsure of who to trust and where to get the right advice, right? Because there's many people in our shoes running around slinging products, trying to sell people in your shoes things because you have a target on your back as a physician. But what our clients and those that we work with and have supported through these master classes have found is that with the right playbook, you can take control. Whether you're brand new to 1099 work or 15 years in, there's a smarter, clearer, more proactive way to approach taxes, structure, and strategy. And this is where the 1099 physician playbook comes in and a lot of what we're going to talk about today. So today you're going to learn how to avoid, or how those that we work with avoid, the most common and costly mistakes that 1099 physicians make. We're going to use some fictitious case studies to compare S Corps and LLCs. We're going to understand how some physicians that we work for integrate solo Ks, maybe SEP IRAs, QBR deductions, family payroll, putting their kids on their payroll, and decide when to file that S election and how to use your home, your spouse, and your income more strategically. So why these master classes exist and why we're here with you today. And so at I Am Wealth, we currently serve about 90 physician families. And we created this masterclass for 2 reasons. One, to give you real, no BS financial wellness education, right? Because we believe deserve everybody on earth deserves great financial education because there is none, but especially every physician because you put hundreds of thousands of hours into to get to where you are today. And there might have been an hour of financial training in med school and residency and where you are working today. And our goal is that this education that you get from this masterclass is better than anything you'd find online for some like paid course or something, go down like a YouTube rabbit hole or anything like that, right? And second is to earn your trust just by showing you exactly how we've helped other physicians like you take control of their money and finally build clarity, not confusion. So something that we do for everybody that registers for this. And if you're with me in the future on the podcast or listening to this on YouTube, this 100% will be applicable to you as well. We give away a free financial wellness diagnostic, no strings attached, essentially just a free assessment of your current state of financial health. Just as a thank you for being proactive. So you go to iamwealth.com and click start here. That's how you can begin your journey with that. And just keep in mind, between Jeff and myself, we can only handle 12 of these per month. I think we're already looking at to September, so feel free to grab one of those if you'd like. So that's our commitment to you through this whole process. No cost, no product pitches, and because of rule number 1 and 2, no bull. Quick disclaimer for our compliance team. Shout out to you, compliance team, for keeping us afloat and keeping us going and keeping us inside the guardrails. The opinions expressed in this masterclass are for informational and educational purposes only and do not constitute financial, legal, or tax advice. Any financial decision should be made in the context of your unique circumstances and in partnership with a trusted financial or tax advisor who understands your personal plan. So now that you're here, let's talk through the real world 1099 traps most physicians fall into and how to escape them. You'll hear from Jeff McPherson here, sporting the beautiful sport coat over there and the headphones and that lovely fake plant in the background. I mean, plant, of his my Zoom background's fake too. But you'll hear from Jeff. He's a CFP. He's taught me everything I know about life and this business. He's my business partner and founder of I Am Wealth. And then we'll also hear of Matt Barzak, who's a CPA and tax specialist who helps 175 plus physicians and 50 practices simplify their tax planning, build powerful structures, and avoid major financial leaks. So we're going to use a fictitious case study to talk about a lot of the concepts that I talked about earlier. So let's jump in and get started. I will go ahead and introduce the case study, and then I will pass the baton off to Matt and Jeff. And of course, I will chime in as well just to kind of like break down how this can apply to this fictitious case study and what types of mistakes 1099 physicians usually make and the playbook, right? So we have Dr. Maya Ellis as a cardiologist at a major hospital system earning 450,000 as a W-2 employee. Her husband, Dr. Jordan Ellis, is an emergency medicine physician based in Florida, earning 475,000 in 1099 collections through a mix of locum shifts and direct contracts with private ER groups. We try to tailor this towards like our number one audience for this being ERG. So shout out to Michelle Drool, ERG, and Jason Buns for making this happen too. So
Shout out ERG. Yeah.
Jeff and Jason Buns played football together at Michigan State back in the day. So if you ever run into Jason, make sure you tackle him in the ER.
Good luck. Good luck
Yeah,
tackling
good
that
luck with
guy.
that. But on paper, Maya and Jordan are winning. Two respected careers, two healthy kids, a beautiful home in Jacksonville, nearly $1 million of income, but they didn't feel like they were winning. What they felt like is we're making great money, so why does it still feel like we're behind? Maybe this resonates with you as well. Jordan's tax bills kept getting bigger every single year. It blew his mind that, his tax bill was higher in his first year as an attending than his income during training, right? I'm sure many of you have experienced that. Their CPA never offered any strategic advice, just kind of filed the return and sent the bill. And Maya was maxing out her hospital's 403B, but Jordan didn't even know how much he could contribute to like his own personal retirement plan, right? Because he didn't have one. So they weren't sure if they were doing enough or doing anything right. And every January they braced for the pain, right? Another 80,000 tax check, if not more, another 12 months of guesswork. They didn't have a plan, just income, and it started to create a lot of tension. So what we heard, right, in this fictitious case study is I don't know if we're missing something, but I have this pit in my stomach every tax season. I feel like I should be on top of this, but I don't even know where to start. We're making more money than ever and somehow still feel financially scattered. So maybe some of this resonates with you guys listening to this right now. And I've been there too. Maya was feeling burnout from nonstop call weekends. Jordan was secretly thinking about taking fewer shifts, but had no idea if that was even possible. Would he be able to save? Would he be able to retire, pay off his student loans, etc.? They were saving a lot of money, but didn't know where it was going or what it was doing. So once in this example, they started taking control of their money and surrounding themselves with the right team and learning about the things that you guys are learning about right now. They started building a plan and walking them through that 1099 playbook, and everything changed, right? So potentially restructuring Jordan's income to like an S corporation and talking about moving old IRAs or a SEP IRA into a solo 401k so they could do some backdoor Roth IRA planning and get some tax-free growth, layering in the Augusta Rule, family payroll, monthly owners draws, putting their kids on their payroll. And most importantly, they went from being reactive and anxious to clear and confident. So that's our hope for you today is that we can take things that you're currently doing and teach you about some of these strategies. And you can go from hopefully reactive, anxious, feeling any uncertainty to gaining more clarity and more confidence than ever before, right? So this is the story behind the physician's playbook, right? And mistakes that we commonly see 1099 physicians make. And without further ado, Matt, let's hand it over to you where we can jump in and talk about, okay, how did they, like some of these different strategies, like S Corp versus LLC, the QBI deduction, does it apply? Moving a SEP into a solo K, like how do we do these things? What does all this stuff mean, right? Broken down and maybe like third grade reading level. I'm just kidding, but so Matt, let's hand it over to you.
James, that's quite the intro. There's a lot there, a ton to really unravel. And I'll start off first by saying, and I think you mentioned this briefly, but every situation is different, right? So James's financial situation is much different than Jeff's, which is much different than Matt's. So the answer for one taxpayer might not be the same answer for another taxpayer. So with that in mind, we'll kind of look at your case study here with, I believe it was Maya. I might even just say it was James married to Jeff for this example. And
Whatever
then
you
that'll give
feel.
me a great background to say 450 and 475. I can
Yeah.
look at the two guys right in the face and say, what do we got going from here? But
Sometimes it feels that way, right?
well, you guys are, you're business partners.
Absolutely.
So if we have, I believe you mentioned, James, in this case study, 450K on a W-2 basis and then 475 on a 1099 basis, right?
That is correct. Yes.
So I think the foundation would have to be, okay, what is the difference between the two from a tax perspective, right? On a W-2 basis, you have your 450K of earnings, you have Social Security, and you have your Medicare tax, so 7.65% on that as an employee. The employer covers the other side of that. So there's an employee and an employer match on that. We call it FICA, but it's Social Security and Medicare. And in addition to that, you have your ordinary income tax. Depending on what state you live in, you might have state income tax as well. So you have, potentially 4 different components of tax within a W-2 environment. On a 1099 basis, those 4 components still exist with a slight change on the FICA or the Social Security side of things, Social Security and Medicare. So the difference there is when the employer covers the Social Security and Medicare on a W-2, on a 1099, you as the subcontractor, the moonlighting professional, has to cover that. You cover the employer and the employee side of Social Security and Medicare, right? So that's step one, is understanding the difference between the two. And to take that a step further, a lot of times we'll see people get burned as, hey, we jumped right into 475K of 1099 income, right? We paid zero amount in throughout the entire year because on a W-2, we were used to having withholding, right? We had Social Security, Medicare, federal, state withholding all taken out on every single paycheck. We might have only seen, 60% of our paycheck on each pay period. Well, on a 1099, you get 100% of that paycheck. The other 40% ends up getting paid in. You're supposed to be doing it on a quarterly basis, right? But that first year can be a challenge. So you might end up sitting down with someone and they're like, man, I made 475 and now I have to pay 200 back. Like, where did this come from? And that's the education piece of sitting down and saying, okay, at least step one, if you're a single member LLC or a sole proprietor, you need to be paying quarterly estimates, and here's what the tax picture looks like. So that's the foundation. Step two being, okay, does it make sense to do things differently? So right now, there's our baseline, our 1099 as a sole proprietor. Does it make sense? So you mentioned earlier, James, does it make sense to switch to an S Corp, right? So then if you're comparing the two of those, let's say, okay, what are the pros and cons of both aspects, right? What changes? The first change being on an S corporation, the IRS requires you to take what's called reasonable compensation via a W-2, right? So the reason a lot of people switch to an S corporation is because you can reduce and not eliminate. Some people think you can eliminate, but you can reduce that Social Security and Medicare tax burden. So if you have 475K in W-2 income or in 1099 income, right? If we were to switch to an S corporation and you took a wage of 150, okay? So we have 475 as your gross, 150 paid out in a W-2, and you have a remaining 325, right? So you have 325 net left over. That 325 is not subject to Social Security and Medicare. So that 325 ends up being what's called a shareholder distribution that's not subject to those payroll taxes. Now, another wrinkle to throw in there is Social Security shuts off at the Social Security wage base. So any income, W-2 income or 1099 income for that matter, you no longer have to pay Social Security after a certain amount. And you might be able to look that up, one of you real quick, what that base is. It adjusts every year, but somewhere around the 170K ballpark. You no longer have to pay the 6.2% Social Security on that.
It's like 176.
What was that, Jeff?
176,000.
176. Okay. So anything that you make over 176 grand, that Social Security turns off. One case study that I had, this is with a prospect a couple of years ago, and this situation, they were an S corporation, they had shareholders. Each of them had W-2s in excess of $1 million, right? And their shareholder distributions were zero. And I reviewed their tax return, and this was for a prospect. And I said, what if I told you that I had and I'm just flipping through the tax return live, meeting this guy for the first time. I said, what if I told you there was a quick way where you could make 6 figures and it would only take one change? And he was like, no way. Are you serious? He was ready to sign the dotted line right there to work with me, right? And all that was lowering the compensation and then increasing shareholder distributions.
Yeah.
And that was the simple change. Even if you lower it down to the Social Security wage base, so we're not making any savings on the Social Security side. All of your savings are on the Medicare side of things. So the Medicare tax of 1.45%, the employee and the employer side, so 2.9%, you're saving 3% on any reduction you have in the wages there. So that's just one change on fully understanding the difference between S Corp wages and 1099 income, right? So that's step one.
Can we just pause for just a second? Because that sounds like an extreme scenario, right? Like, just out of curiosity, why were, like, in their words, why were they not doing that before? Was there something they weren't aware that they could do?
Yeah,
Basically,
I mean,
and there's just like
that's
everything
exactly
they're
what
paying
it
out
comes
in a
down to, Jeff.
W-2.
It's you're not afraid of the things that you know. It's what you don't know that'll burn you, right? So that's just a prime example of something they didn't know and they just weren't getting proactive advice on. That's something that is pretty easy for most CPAs to be able to advise them on. I just think it was almost, you've heard of the mentality of set it and forget it.
Yeah.
That's probably the mentality of that professional, right? Set it, forget it, collect your information at the end of the year, give them their tax return.
Right.
We don't really look for opportunities to change things, and they've done it that way for 20 years, so why change now?
Yeah. Yeah. I didn't want to derail like where you were going next, but that was just I've never heard that story before, and I was just curious, like, how did that business or those partners or business owners get to that spot? So it sounds like that was a really significant savings they were able to achieve just by making that one small tweak, right? Paying themselves a smaller wage, reasonable wage, and then taking the shareholder distributions on top of that. And they're like 6-figure difference in what they're able to take home individually.
Individually, it ended up being, so if we, let's just say $1 million, bump their compensation down to 400 even, just for example. So if you took 600 grand times the 3% roughly, you're talking 17K per shareholder.
Yeah.
So
I think if anybody put a $17,000 check on the table, you'd like pick it up and deposit it. Right?
Well, plus if you have a wage over 250 grand, there's also a Medicare surtax on top of your regular Medicare. So it doesn't stop there. It seems like the government's always trying to get theirs, right? So
Yeah.
I mean, that's where we come in to try to minimize what we're paying out.
Yeah. I mean, and I won't get like too fixated on it because I don't want to stall us out. But I'm just looking at that in terms of like, let's say if that set of partners had, you know, an extra $17,000 a year, you know, 17,000 a year that they like wouldn't have known was even there. They capture that and put that into like a brokerage account, let's say, and they do that for 10 years, an average 10% a year. You know, that's like, and now they're sitting there with 176K, you know, that's like, it's just the way that it adds up over time too, not just in that one tax year, but making small changes like that. I'm sure there were a lot of other changes that they were able to make too. But, yeah, that's something that like, if you don't catch it, right? 10, 20 years go by and you're missing out on some serious opportunities.
Right. So yeah, 10 years at that rate, right? Each year, 17 grand per individual. I mean, you end up talking $1 million easily over the course of a career.
Yeah. Yeah.
Yeah. So if we start to look at a conversion from an L, and there's a lot of other factors that we'll get into too, but at the baseline, what does a conversion from LLC to S Corp look like, right? And I always say your foundation should still always be LLC. An S corporation is just, from a tax perspective anyway, it's what we call a check the box election. All we have to do is file one form with the IRS, and it's within 45 days of the beginning of the year. And we just say, hey, IRS, we want to be treated for tax purposes as an S corporation. We do not want to be treated as a sole proprietor going forward. So that would be step one. I would never say be an S corporation right off the bat, just because S corporations are a bit more complex to set up from a legal perspective. So LLC is the easiest approach. Do this check the box election, and then start to look at, okay, we need to be treating this as a separate business, right? So we need to create a separate bank account for the LLC. Any business transactions should be running through this separate bank account. We don't want to combine anything individual with our business world, right? Because then now all of a sudden we are, it's called piercing the corporate veil, right? So we pierce the corporate veil, and now all of a sudden anyone who tries to come after us for our business assets due to, we'll call it malpractice, for example, you got malpractice insurance to cover that too. But if they came after your business assets, they could also come after your personal assets too, if you're using more or less your business account for personal reasons, or if your business account didn't exist, right? And you're using your personal account for business reasons. So that's a key distinction there, as well, as you want to have the separation of the two. Another item to branch off from that. So first we talked about the payroll tax savings, potentially in an S corporation world. It definitely does not always make sense to switch to an S corporation. One example could be, so we have this case study of 450 grand W-2 and 475 on a 1099, right? If, for example, that W-2 income went away, so we got one individual that's kind of the breadwinner at 475, or even call it 375. If you file an S election and then have to take that reasonable wage or compensation on the back end, right? So we have a spouse with 0 and a taxpayer with 475. That W-2 income that you have to take is not eligible for the qualified business income deduction. So the qualified business income deduction is a 20% deduction that all business owners receive right off the bat from their income. So if you have net income of 475, what's 20% of that? That's your deduction for the qualified business income deduction. If we filed an S election to flip that, right, we have 150 grand of wages. That leaves us with the 325 of net income on the S corporation, right? The 325 is eligible for the qualified business income deduction. the 150 is not. So 150 grand times 0.2 is that's a $30,000 deduction that we lose flipping to an S corp. So 30,000 times a top tax bracket of 37%, that's 11 grand. So 10, 11 grand you lose by flipping to an S corporation if you flip from a Schedule C to an S corporation, right? Now, the reason I say the spouse was at 0 and the taxpayer was at 475 in this case, or 375 would be even better example, is because this qualified business income deduction phases out. So after 400K of taxable income for a married couple, it starts to remove that qualified business income deduction if you are a healthcare professional or any professional service provider. After 500 grand, that QBI deduction goes away completely. So in the case study here, we had 450 grand W-2 income, 475 as a 1099 income. If this 1099 individual switched to be an S corporation, that's perfectly fine because they don't lose out on the QBI deduction because they weren't eligible for it anyway. Their income was over that 500K limit, and that's one of the areas that we don't have to worry about. But if their income was lower and they flip to an S corporation, hey, we need to be mindful of that 20% deduction that we lose on the W-2 income for an S corp shareholder. Is that all? That was a long-winded QBI explanation. It might have been fairly complex, but did that example make sense?
Yeah, I think the one thing that's like a key takeaway in there is with a lot of the couples that that we work with in that dual physician couple space, right? That's one key area that you need to pay attention to, that one detail, because some folks might like you said, what works for one person may not work for another. Like we've had dual couples that had a colleague that they were talking QBI and they thought, oh, well, we need to make sure we're doing that. But they had a spouse that had a bunch of W-2 income, and it changes things. So again, with the dual physician space, that's an important detail. Definitely. I think that'll be a key takeaway there. And then the other thing too, Matt, I just wanted to go back to like when I was entering that number for that 17,000 a year, I was like doing it fast on my calculator and only put in a return of 1% a year rather than 10. I missed the 0. So it's like 170 grand over 10 years with that 17,000 a year actually grew to be 270,000, not 176 or whatever the number was.
Something sounded off with that.
Yeah, it's like, wait a second, what?
So
yeah.
Matt, in our example with Jordan and Maya, or James and Jeff, whatever we want to call it, and I know every situation is unique. Like, would an S corp make sense, or would losing out on the QBI deduction not, or like, is it kind of hard to say like exactly right this second?
I mean, I think we need to steer away from oversimplifying it because there's a lot of additional factors that we'll continue to get into that change in a sole proprietor versus an S corp world. I think you'd still have to get into the specifics. So we know one, our starting point was the FICA taxes, right? We know flipping to an S corporation, we would save in FICA taxes. Okay, so that's a positive. Our second step was, how does the QBI, the 20% deduction, get affected by making this switch, right? Well, we decided in this specific example, since the income for both the taxpayer and the spouse was over that 500K threshold, the QBI is eliminated in either situation, right? So on a 1099 or an S corp, the QBI ends up being 0. So step 2, or topic 2, being QBI, net to 0. So we're still up in the S corp world if we made the switch because we're saving in FICA taxes. Okay,
that makes sense.
So we'll keep diving into additional factors. I think we probably have 4 or 5 more factors that change in an S corp versus a 1099 world, and so we'll see based on this situation what it looks like. So one area that we see a lot of times for physicians, business owners, you don't have to be a physician, but really any business owner, is the concept of their children on payroll, right? So when you employ an individual under, I believe it's 16 years old, it might be 18 years old, but when you employ a minor and they're your child and it's through a Schedule C or a sole proprietor, that individual or that child is not subject to Social Security and Medicare tax or unemployment taxes for that matter, right? So you can pay your child through this Schedule C or 1099 income, okay? As long as that individual makes over or less than the allotted amount that any individual can earn in any given year without having to file a tax return or be required to file a tax return, you can put 0 as their federal and state withholding, right? Because they don't have to file a tax return. I believe the amount is somewhere in the ballpark of 12, 13,000. It changes for inflation every year. So if we pay a child 10 grand a year, we'll call it, through a Schedule C, not subject to federal income tax, state income tax, not subject to Social Security and Medicare, not subject to unemployment taxes, right? That 10 grand was a deduction for you as an individual, and it was tax-free income to the recipient, your child. If we were in an S corporation world, the S corporation removes the related party component because the S corporation is considered its own separate entity that's unrelated to the child that is being paid. Okay. So now all of a sudden, Social Security and Medicare gets thrown in there. We're still not subject to federal and state income tax because we're below the threshold for them being required to file a return, right? So as long as they make under that 12 grand, we still have savings there, but we have Social Security and Medicare that gets thrown in. And we have, as you guys have seen, right, we have the employee and the employer side of Social Security and Medicare when you're on a 1099 basis. So that's another factor to consider. Hey, do we have children? Does it make sense in our situation to have children on payroll? And if we do have them on payroll, what is the change in our payroll taxes that we're paying through this payroll? Does that concept make sense? And you guys can get into as well. We have 10 grand of tax-free income in this situation and earned income for this recipient. What do we now do with this tax-free 10 grand, right?
Yeah, Jeff and I did an entire masterclass. It's on YouTube. It's on the podcast, A Life Well Lived, A Physician's Guide to Wealth on any major platform. I think it actually released like last week. Or if you go to our website, iamwealth.com/1099kids. So that's letter I, letter M, wealth.com/1099kids, all one word. We actually built like a free guide that kind of like walks you through the whole process of putting your kids on your payroll. We had a lot of fun with that. But I know what Jeff and I had talked about is, if you contributed X amount to like a Roth IRA, the money's never been taxed. It grows tax free. And if that gets on average like an 8% return and the kid's 10 years old, I mean, the numbers are like astronomical. And once again, this is all like a sample, right? For the compliance team, we can't guarantee any returns. Or if you take money you were never taxed on that you would have given to the IRS and you pay your kid with it, and then you contribute to a 529 plan and that grows tax free. So it's just like a lot of like, tax workarounds to be efficient. Of course, you have to put your kids on your payroll and it has to be like a legitimate job that they do for you. You can't just give them like an allowance in their bank account and say they're working for you. But
Yeah.
so Jeff, is there anything you want to add? I think that's, I mean, I don't think we could go down that rabbit hole for the next 25 minutes, but I think that's a really unique
Yeah.
strategy that a lot of either mistakes are made or physician families miss it, or I've talked to a lot of 1099 physicians. They're like, oh yeah, my tax advisor's like not comfortable in doing that. Like that's not like a real thing, which we've seen many physician families do it and be very successful with it, and have no issues with the IRS. So anyways, can't guarantee that either, but I know it's a strategy that we're all comfortable with. Jeff, do you want to add anything
Yeah.
to add or?
Yeah, just the one thing would be where we see people getting the most bang for their buck out of that is with parents who are already saving money, putting money away for the benefit of their children, but they're doing it with after-tax dollars, right? Their own personal income. Once their own entity that they own has paid them their wage, and then they paid their IRS has gotten theirs, and the state's gotten theirs, whatever. And let's say if it's 10 grand a year going away into a 529 account or a custodial brokerage account or whatever it may be. If you're doing that with after-tax dollars, and you have an opportunity to give the kids a meaningful part-time job, that's fantastic because it's just a way to put away the same amount of net money, but do it more tax efficiently. And people get really excited about that for sure.
Mhm. So for anybody out there, once again, imwealth.com/1099kids, 100% free. And there's a whole list of even like potential jobs that you could like employ your kid for as a physician. But yeah, no, that sounds good. Matt, what do you have? What do you have as the next mistake? Or were you going to retirement plan next, or did you have something else in front of that?
Wherever the heck you guys want to go. I think it's a great segue to retirement plans for sure. So
Yeah.
you look at a SEP or solo 401k, for example, the difference between an S corporation and a 1099. An S corporation world, it's going to be calculated a little bit differently than on a 1099 world. So in a 1099 world, you might just take your net income and then multiply it by, if you're in a SEP, for example, you multiply it by your 25%, and at the end of the day, that's ultimately what your deduction is, right? If you flip to an S corporation, that calculation is now based off of your W-2 income. So, hey, did we kind of shoot ourselves in the foot here because we have an S corp or a 1099 income that we could contribute more to a SEP before we made an S election? So that's just how the calculation works. When you're Schedule C or sole prop, your bottom line net income is multiplied by the rate, and that's what your contribution limit is. And in an S corporation, that percentage is multiplied by your W-2 instead of your bottom line. So in this situation where we had this case study, right, we had 475 grand of 1099 income. If we flipped him to an S and changed his or her wage to 150, that 150 times the rate is your new contribution that you can make into the SEP, 20% or whatever that is.
It's 30,000 if it's 20% of 150.
And then multiply that by 475, you might be able to get up to, and there's SEP calculators out there too to know what your exact contribution ends up being, but you end up lowering the amount if that's a high priority for you, right? So if that's the case of, hey, we're flipping to an S, does it make sense to have a different type of account? You know, just because we have a SEP or we've used a SEP or we want to go SEP doesn't mean that that's the best solution for us. So then we can pursue, as you guys are familiar with, a solo 401k, for example, or a regular 401k or a 401k with a profit sharing. So there's a lot of different avenues you can go down, right? But just being mindful of how your retirement world is going to change in a 1099 versus an S corp environment.
Matt, when you see like you talked about the contribution limits for a SEP, and I know every case is unique. What does it look like in a solo 401k? Because I think there's the three components, right? There's the employer, there's the employee, and then there's, I think, the deferred comp segment of it. And you can get almost up to like 70 grand. Can anybody do that, or are you restricted based on like if you are S corp versus sole prop? What does that look like?
Yeah, you're restricted in the sense of, let's just say hypothetically, I have another employer that I get paid on a W-2 basis, right? And I have my 1099 income on top of that. If that original employer, if I'm deferring or using my deferral or having a 401k contribution with that employer, that reduces the amount that I can now do in a solo 401k on my 1099 income. So a solo 401k, if you're a 1099 basis, you have your deferral limit first, and then you subtract that from your Schedule C income, and then the calculation occurs after that of the amount that you can put in, similar to the SEP contribution. But you automatically get that deferral no matter what your income level is. So when you're on a lower income level, the 401k or the solo 401k, I should say, tends to make a lot more sense. And then, like I said, being mindful of if you have another W-2, how does that play a factor in? If we're maxing out deferrals on a W-2 already, and we have 1099 income as well in addition to that, does it make sense to be a solo 401k if we don't have that deferral component now? So now we can just say, okay, well, we can do a SEP in addition to the 401k that we have through our other employer. Let's just use a SEP and multiply the bottom line or the net income by our contribution rate and do that instead.
Right.
In the fictitious example, with the 475 of 1099 income, like could they put probably almost like the full 70 into the solo K if they wanted to?
Jeff, you have a calculator for the contribution level. I know there's one that you can Google quick to compare a SEP versus a solo K using 475 of a bottom line, right?
Yeah,
Um,
I think in that example, they'd both be able to, like the higher the income gets, I feel like usually once that net income gets north of like 350-ish, maybe 400, the SEP and the solo K end up being pretty much neck and neck at that max amount. But like for
Max,
like where
right.
the income is, the net income being a little bit lower, like if you got, and we've seen people like this, right? They may have a W-2 full-time, like they may be full-time as a W-2 physician, but they pick up some locums work and maybe they collect 200 and they have like 50 to 75K of expenses, and maybe their net income's a little bit lower on the 1099 side, and that solo K allows them to put more away than maybe the SEP would, right?
Hmm.
So
Okay.
but I think also too with the solo K, one of our favorite things about it is it opens the avenue to do the backdoor Roth IRA planning. Whereas if somebody's got that pre-tax SEP IRA money, that just all of a sudden it brings in that pro rata rule, and it just becomes real tax heavy to still do any backdoor Roth
That's a
stuff.
great point, Jeff. So to elaborate a little bit more on that, and I don't know how many people are familiar with the backdoor Roth conversion, right? But if you're over the Roth contribution limit, which is shade over 200 grand, so if you're married filing joint and your income's over 220, we'll call it, you're not eligible to contribute outright to a Roth account. But you can still contribute to a Roth account. It just has to be via this backdoor mechanism. So how that works is you contribute to a non-deductible IRA, and then you immediately or subsequently convert that into a Roth account. The problem lies when you have multiple deferred tax accounts, or it can even be one deferred tax account. When you do that conversion step, you can't pick just the non-deductible IRA and convert that. You have to pull pro rata, as Jeff said, between the non-deductible IRA and your other deferred IRA. So now all of a sudden it creates a taxable event because you had to pull from your deferred IRA account. So that's why what Jeff said was important. A SEP is an IRA. A 401k is not included in that calculation. So we can set that aside and not worry about it. But a SEP, we would have to consider, okay, what portion of that did we convert over into the Roth account? And then ultimately that percentage would be taxable. So unintended consequences of a backdoor Roth conversion.
Yeah,
I think that's
and
one of the biggest things, and I don't want to use the word necessarily like mistakes, maybe, but just since like seeing more and more 1099 physicians, we've done more work in that space, is most come in with a SEP and they don't even like, they're just like, I can't do Roth IRA, like I'm over the limit, right? But it's like, well, you could move it, and this isn't a direct recommendation. Your situation's unique, right? Talk with someone like Matt, your financial planning team, and see what makes sense. But you can move the SEP into a solo K, free up space, and then do the backdoor Roth, and then you'll have money in the Roth that grows tax free for the future. Jeff, what were you going to say?
I don't remember.
Okay.
But that's great. But that is true though, for sure. Yeah, I agree with what you're saying, James.
So I think that's the biggest thing for like retirement is just optimize it and figure out what's like best for your unique goals, right? Is it being able to put the weight the most possible so you can reduce capacity ASAP, or do you want to save more tax in the present? Like kind of what are your goals? Figure out, self-assess, and then figure out like what makes the most sense and work with your team on that.
Yeah.
Matt, do you have anything else on retirement optimization?
Great on retirement. That at least narrows down the difference between S Corp and 1099 world for retirement and how that potentially changes, right? So ultimately, we're just deciding what is the best entity type? How can we reduce taxes? And if we do, make this change to reduce taxes, what other areas are affected by that? So retirement accounts being one of them. Another area where a potential switch to an S corporation is beneficial. So we mentioned earlier how an S corporation removes this related party component, right? So I mentioned that in terms of the Social Security and Medicare taxes on children in a 1099 world, or Schedule C or sole proprietor world, we're not subject to that, but in an S corporation, we are. The removal of this related party rule creates what we call, or what the IRS call, I should say, the Augusta Rule. And on a 1099 basis, you cannot use this to your advantage. In an S corporation, you can. So what this Augusta Rule is it was, I believe, created, I'm pretty confident it was created a long time ago when there's people renting out their houses near Augusta National, right, for the Masters. They're renting out their house for a week during the tournament, and shoot, these houses are pretty nice down there. I don't know if you've ever been there, but they might rent it out for six figures. They have
Right, for
six
1
figures
week,
of
right?
for 1 week,
Yeah.
literally 1 week. So they have six figures of income that they have to file on their tax return and then pay tax on that. Well, I think those people are also very connected as far as political, being
Lawmakers.
politically inclined or connected. They might have been friends with the president at the time. I don't know, but so they passed this law that said if you rent out your personal residence for less than 2 weeks, you do not have to claim the income as income on your tax return. Okay, it's called the Augusta Rule. So what does that give us, right? Just because these people are renting out their personal residence during Augusta doesn't really give us anything. Well, what you can do and again, it's got to be an S corporation. You cannot do this as a 1099 because you cannot rent to yourself. In an S corporation, it removes the self-rental piece because we are no longer related. We're no longer related to ourselves. Our S corporation is a separate entity from us individually. So as your S corporation, unrelated, you can rent your personal residence. And of course, there's got to be a business purpose to it. One example could be board meeting with an attorney, meeting with CPA. So you can use this as a meeting space, right? And then cut a check from your S corporation to yourself individually. Now all of a sudden that check was a write-off on your S corporation. So we'll call it 37% of a deduction. And then on your individual side of things, you don't have to pick it up as taxable income.
Right.
So this is a method that quite a few of our practices utilize. And I'm trying to think of the website that we tend to use to look up what is a fair market value of meeting space in your area. Because, and I just had this conversation with a client earlier this week. They said, I just built this massive house, right? We're talking $5-6 million house. And if someone was to rent that out from me, we're talking well into the thousands. Well, there's a court case that the IRS just ruled on a few months ago that said, well, I don't really care what the fair market value of your house, your residential space rents out as, because you're not using it as a residence. You're renting it out as a meeting space. So you have to take the fair market value of that meeting space relative to other meeting spaces in the area, and that's what you need to be charging your S corp, not a residential rate. So you need to come up with an hourly rate on a meeting space, times it by, hey, we met for 3 hours that day. 3 hours times $200 an hour, right? Might be $600. And then you do that several times throughout the year. Well, 2 weeks or less than 2 weeks, you'll find there's 24 hours in a day, right? If we rented it out the first time for 3 hours, we can do that 6 times and just get up to 1 day. And all of a sudden we can do that another 13 times or 12 times before we even get close to the limit, right? So you can write off a pretty significant amount if you can find enough opportunities to rent your space out.
Hang on one second. I just want to make sure I'm understanding that one. So, because I've not heard that. So it's like, am I understanding you that you're saying you have 24 hours of, so it doesn't necessarily have to be limited to like, hey, if you had 2 hours on that day of that one of 14 days is now burned, right? Like you have 24 hours times 14 that you
That's
can
how I
use.
view it.
Okay,
Correct.
okay. Just
That
want
is
to,
one
so
day.
so theoretically it could be spread out across like, 30 days or something, but you're just using blocks of hours. You have 24 hours times 14 days in a
Right.
calendar year. Okay.
Right.
That's really cool. That's something I did not know.
If you can find that many opportunities to rent your space out, right? I mean, if we're
Right.
looking at it from a professional meeting space perspective, it can be fairly difficult to come up with 30 different times to do that. But
Right.
Matt, what
Right.
what would be some examples of this? Like if 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 Jeff had a beautiful home and you being like our tax team brought you in, like could you meet with your tax team? Does that count as a meeting? Or does it have to be like internal, like Jeff and I meeting to talk about I am wealth strategy? Like what does that look like?
it's anything business related, right?
Okay.
So if you're using that time to further your business and professional advice being one of them, I'll expect the invite later today, Jeff. So
But you could host and entertain colleagues, right? That kind of thing. And in our world with docs that are, they may have some sort of like partner, party, right? Having their colleagues or their business partners or their staff, their whole team over for a barbecue. And that may be a 5-hour event right there.
that's a
So
great
yeah.
example. I
Okay.
like
So
it.
It
colleagues,
could be
vendors, yes,
okay.
professional team members. You nailed it, James. Yeah.
Okay. I didn't realize you could do it for like business entertainment as well. That's interesting.
Yeah, so there's a distinction between entertainment and office.
Okay.
So you would have to bridge that gap of what qualifies as entertainment versus what qualifies as so an office party, for example, is not considered entertainment.
I see. Okay.
So at that point, it would be a matter of, okay, what delineates between entertainment and an office party or a holiday party, right?
Mhm.
So
Yeah.
Let's say moral of the story is find a very proactive tax team that's willing to strategize with you
Right.
versus just file a return for you, which is once again
Right.
a common mistake we see with a lot of the families we work with, especially the 1099 families we work with, is their tax team. And Matt, I remember you explained this really well. There's like proactive and there's reactive. There's them like that just process your returns in Q1, and there's those that you like meet with 2-3 times a year and get proactive advice like from like you have with like Jeff and myself. Wow, words are a little hard right now. So we have 5 minutes.
Oh, wow.
Do we want to bring this all together? Are there any other things that you want to talk about? Do we want to take any Q&A for a couple minutes? Like, what do you guys, what feels good? Matt, I don't know if you had anything else on your list that you really wanted to talk. Like, I know there's other things on the list, but we can never get through all of them in one of these. So cliffhanger, stay tuned.
Yeah. Yeah. Go ahead, Matt.
I'm open to anything if there are questions, definitely. That's first and foremost. But the only other thing that I have on my list is the change with the big beautiful bill a couple weeks back. They increased the salt cap deduction. So salt being state and local taxes. So you have real estate taxes and any taxes you pay to a state. So if you live in a non-taxable state like Florida, for example, this wouldn't apply necessarily. But an S corporation world, this might be another benefit of switching or filing an S election, is you can just, for example, in the state of Michigan, right, you can pay your state income tax through your entity and deduct that payment on your business return. Instead of, as a 1099, you pay your income tax to the state through your individual tax return, and then you have to itemize that through your itemized deductions. Well, your itemized deductions are limited as far as the state income tax and the real estate tax component has always been limited to 10 grand, or at least for the last 7 years or so, it's been limited to 10 grand. The new bill that was just signed a couple weeks ago increased that threshold to 40 grand. So it's just another example of, hey, it diminishes the return on investment with an S corporation a little bit because it lowers the amount of benefit we get through that FTE or flow through entity deduction. So hopefully that gives a quick summary of the change on the SALT cap there, but
That was
Yeah.
perfect. Once again, I think moral of the story too is like, even in our fictitious case study with Maya and Jordan, like there's a lot that goes into it, and everybody's case, even just their example, we would need way more details to actually provide like formal recommendations of like, hey, here's exactly, and a lot of it's based on their goals. Do they want to put their kids on their payroll? Do they want to do these things? Do they want to do backdoor Roth? Like, do they have a home that they can do Augusta Rule for, those types of things. So it's
Right.
so nuanced and unique, right? So I think it's kind of like full circle moment of everybody's situation's unique, and definitely surround yourself with a capable team to help you get it done and complete the mission. Jeff, were you going to add anything else?
I think, yeah, the only other thing too, just piggybacking off of what you were just saying there, James, is like some of the other popular deductions that people will start to get creative with S corps is they'll, look at home office reimbursements if they have that kind of space at home. They'll look at vehicle leasebacks, like situations where you already have certain at like whether it's a vehicle or a home office that people are currently using, but you're able to create some more deductions with that. But again, it's like head-to-head combat, sole prop versus S corp, and then just nailing it down all the way down. Like you said, James, with they're going to get a spouse or children on payroll and all the different things that you are capable of doing with an S corp to see is the juice worth the squeeze, right? Doing all this extra work, are we going to net a better result, or are we better off this maintaining everything as a sole prop right now? So everything's unique, and but yeah, I think some of those other deductions, that might be something for us to unpack again another time, like some of the nitty-gritty stuff where people are maybe missing just some of the finer details that they can create some extra expenses to keep some more money in their family's pocket.
Mhm.
spot on, gentlemen.
Thank you all. We're at the top of the hour. I want to respect Matt and his time. So if you do have individual questions, Jeff and I will follow up with everybody that registered. If we're bothering you and you want us not to contact you anymore, just let us know. But if you want individual questions answered, we'd definitely encourage you. Or if you're listening to this on YouTube or the podcast, go to iamwealth.com, book one of those free financial wellness diagnostics. They're 100% free, and they're for you to take full advantage of. Otherwise, we can reach out to everybody too, and just right, I probably will, and make sure that all your questions got answered today, and also get some feedback of how the situation went. But Matt, you're amazing. Thank you so much for being here. Jeff, you're amazing. Thanks so much for being here. I know both of your times are precious, but it's always a ton of fun when we do this, and I learn every time. So that's why we
Yeah,
keep these things up. So I
yeah,
can.
we learned a lot today.
But
Useful stuff, yeah,
yeah.
really good.
And whether you're here in the present or here in the future listening on YouTube or the podcast, thank you for your time and attention, because I know it's the most valuable thing that you have. And hope everybody has a great rest of their Wednesday, and happy taxes to you the rest of the year.
Happy taxes.
Make sure you get your midpoint through the year meeting in with your tax team as well.
Yeah. Awesome. Thanks, Matt. Thanks for joining, and thanks, James, for running the show. It was a
Yeah,
great session.
absolutely. Have a great rest of the day.
See ya.
Bye, guys.
See ya.